first with in the cash segment, and then slowly I moved on to futures and options. And right now I'm doing in all the segments, sometimes positional, sometimes intraday. So I'll talk about the various strategies which are found profitable over time. It doesn't really matter whether it's a bear market or bull market, as long as one sticks to basic principles. So there's no guarantee of 100% success with these strategies, but if you follow them strictly, you should see about 85 to 90% success investments, or whether it's just trading. So the agenda, right? So when to trade and when to invest. I'll talk over that. The difference between both. The bull pressure point, bear pressure points, moving averages, and Marbuzu. Marbuzu is a specific candlestick which I actually love, whether it comes to buy or sell. It works pretty much on most of the time frames that you want to use, and it's fairly a reliable indicator. Moving averages, this is basically like a guideline, whether you want to invest or whether you want to get in or get out of a particular point. Then I want to talk about a few chart patterns if we have time, or we could do that in the next session. So these are like fairly reliable chart patterns that work only purely on the basis of chart patterns development. You don't really need other indicators for this. And then obviously the Nifty option chain, so that for each series you can get a specific range where Nifty would be in, or a specific stock would be in. So basically, the funda of trading is all the same, right? You want to buy low and sell high. It's just like how you go to a regular shop. You want to buy goods as low as at the lowest price as possible, and the seller is trying to sell it as high as possible. So it's the same concept in trading too. It's just that it's just a financial instrument for stocks, and when you go to a regular supermarket, you just have the regular products like toothpaste. But both have the same end goal. The goal is basically maximize your returns on your sale, or basically get it as profitable as possible. So if you are a consumer, you're looking to buy it at the lowest price as possible. And when you want to be a seller, you're going to say you want to sell a used TV or something. You're basically looking to sell your TV at the highest rate possible. So the same principle applies in stocks. It's just a financial instrument. There's nothing confused. There shouldn't be no confusion about this. So ultimately the goal is the same. You buy low and sell high. And the technical indicators are basically just a guideline to help you evaluate that position. Investing is a slightly different trick. Investing is basically a form of participation in a firm's growth story. So, for example, Infosys has grown from hardly anything from basically a nothing company to a 20,000 crore company. So you basically want to be a part of this setup over time. And the idea of investing is that you hope that the management would basically reward your investors for sticking with them over time, and the reward comes in the form of dividend, bonus shares, whatever you want to call it. In the audit sector in India is slightly unique. They don't give bonus or dividends, but they basically play on the share price growth. So you've seen Eicher Motors grow from 600 to 30,000 plus, and Maruti from about 720 to 9,000 plus. So one thing you guys have to be clear is, what do you want to do in the market? The markets provide opportunities for both types of players. So you need to figure your style. Are you a person who wants to invest in the firm's growth story, or are you a person who wants to basically say, hey, I'm going to trade for a few days and cut my position and see whatever profits I get, push it into something else. So you need to figure that style out, and only you can do this because investing pretty much involves slightly different tricks with chart fundamentals. So some of it relies on fundamentals, balance sheets, and stuff like that. But by and large, you can be safeguarded with a few chart tricks. I can tell you. Okay. So let's get to the next point. So bull pressure point. So this is what I call like a single point of entry where the bulls take over. So you see stocks like, for example, most recently was Axis Bank. It just flew from 680 to about 710 in no time. So basically the low that day I think was about 683, which never broke. So you basically try to identify these points where bulls are trying to be active, and that gives you a reasonable chance on the buy side, so that you don't get on the wrong side of the trade. When a runaway happens either on the buy or the sell side, and if you're on the wrong side of the trade, you're going to have huge losses. So the bulls basically usually come at support. So what is the support for the stock? Usually for intraday trading, you look at the 20-day moving average on the hourly or on the daily. You need to have both these numbers at the back of your mind when you see the charts. And you basically enter in at this point and just exit at the end of the day. And of course, you need to have a stop loss. So if you close below the 20-day moving average, then the stock is going to be bearish. And then you'll have to exit on the stop loss hit. Okay, so similarly for so simple mode. The name says it is basically just like the historical average of over a period of days. The time frame can be anywhere between 5 minutes to 100 days, depending on how you want to, depending on what type of position you want to take. Typically, the longer the moving average, better you're going to be your results. You cut out a lot of noise in your chart. Your result positions are going to be better and more rewarding. Somebody had a question? Yeah. Okay. Yeah. So Marbozu, this is a beautiful candlestick which tells you where the bulls have come and where the bears have come. So green Marbozu, typically I use green for the bull entry, and I use red for the bears. If you see a green Marbozu, it means the bulls are in control. And if you see a red, and if you see a red Marbozu, it means the bears are in control. So how does the Marbozu look like? So this Marbozu, it had no wicks. Up and for when I'm trading, I look for a variation of this. You don't get perfect Marbozus during trading, but you get somewhat near there. It may have a bull wick and a slightly slow bearish wick at the down, but to some extent, I think there's a good. You can use that variation for the same result, right? Okay. So what is the trade setup that you need to look at? So you need to have a simple and a clear
muted
setup. If you're a beginner with trading, right, I would advise you to use the 20-day SMA and the 200-day SMA on your screen. You have to have this. Keep this on your screen all the time. The time frame for if you want to enter in and exit out quick, use 3 minutes or maybe 5 minutes. If you need bigger profits, you use 1 hour. 1 hour is going to eliminate a lot of noise on your chart, but you can get a profitable trade even within 3 minutes. So remind us again, this is for beginners who want to know about trading, who want to know when to enter and stuff. You have these two SMAs on your screen along with your candlestick chart pattern. Okay, so when to buy? You wait for an hour, so don't trade until 10:15. Okay, between 9:15 to 9:30, all the previous day positions tend to get settled down. All the STBT, BTST, and stuff, all those tend to get settled down. And then by 10:15, you're going to have a clear trend with respect to the market. So as far as the bull case goes, so when you buy when the 20 SMA is above 200 SMA, the 20 SMA is rising, and the Marbozu is formed around the 20 SMA. Okay? So these are your three conditions for your bull case, and you're going to have, and if you stick on with it for about 15 to 20 minutes, and you should be profitable in no time. And what is your stop loss? Just about 50 paisa lower than the base of the Marbozu candlestick, right? So let me exit the presentation, and I want to show this on the 27,000 C that skyrocketed on Friday. I mean, let me just log in here. So can you see my screen here? Okay, let me just add that.
We can see the same screen.
Okay, good. So I'll just add that Bank Nifty 27,000 CE and what happened towards the end of the day. This is on Friday, right? Okay. No, I think it was on Thursday. Nonetheless, okay. Okay, so this is a chart, right? So here is what I was trying to tell you here. The 20 SMA is rising at this point. If you look at the previous thing here, it's rising here, rising here, rising here. I don't see the 200 SMA. Maybe it's not on my chart here. Okay. I don't see the 200 SMA on the chart anyway. So we found the first Marbozu at this point here, just below and it closed right below the 20 SMA here, right? Okay, you don't get in the trade here as per your setup. You just wait and wait and wait. So you form the other one right at this point here. At this point, you say, I'm going to jump in and take the trade with the stop loss at the base of the Marbozu. So you enter in at the high of the Marbozu, which is around 284, and your stop loss is going to be about 270 roughly about, because the base is 273. You enter in at 284, and your stop loss is going to be basically about 284 to 270, basically 16 rupees or 14 rupees. And then you wait for about 20 minutes. So you get a nice little, since your SMA is already rising, and your Marbozu is formed, it basically means the bulls are in control here. You just buy and just let the bulls do the work. Okay? And you basically with your profits. I don't put a targets with this strategy because each one's risk appetite is different. So as long as you're profitable and your stop loss is not hitting, exit according to your risk appetite. So I would typically exit it here, which is around 321. So it gives me a good neat little $50 in about 20 minutes, and you exit the trade out and you rest for the day. So this is the kind of setup I'm talking about, and this pretty much works on all the time frames, whether you want to do it for investing or whether you want to do it for trading. This is like a common setup that you need to look whether the Marbuzu is formed, whether the bulls are in control, or whether the bears are in control, right? Okay, this was one of the things that I traded not too long. This was around back in November or December. I traded Aurobindo Pharma, and this was around the SMA. The blue line is the 200 SMA. The red line is the 20 SMA. And I entered in right here, and I exited at about 820 or 830. So it gave me a good $20 in about 5 to 10 minutes. This is one of the chart patterns which I traded not too long ago. Okay. Now going to the bear setup, right? So it's basically the reverse of the bull setup. Your basic condition is going to be your 20 SMA below the 200 SMA. SMA is falling, the 20 SMA is falling, but your slope of 20 SMA is negative or down, and you have a red colored Marbuzu formed around the 20 SMA. Okay, so let's look at the Ashok Leyland chart. You can use the same setup for cash or future. It doesn't really matter. Whether it's cash segment or future segment, the concept is still going to be the same. So, okay, Ashok Leyland has given the beautiful setup on both buy and the sell side, both on the same day, right? So here you see the big Marbuzu being formed right at the 20 SMA. You go long here, you wait for 15-20 minutes and exit out wherever you want, okay? And then you have the red Marbuzu formed here, okay? The red Marbuzu is formed here. It's a big Marbuzu. Your stop loss is going to be at about 86, and your entry is at the end of the Marbuzu, which is 84. So you 84.5. So you basically short Ashok Leyland at 84.5 because your big Marbuzu is formed below the 20 SMA. Your stop loss is about 86.13 roughly about. You get a small left. The bulls are trying to get back, but they fail, and then you exit out at about 83.4, roughly around 83. So I mean, these are basic, and again the bulls have come back here towards the close. So I think Monday should be good for Ashok Leyland if you want to trade it, depending on if you want to go long on Ashok Leyland. Anyway, so this is the basic idea of the Marbuzu. It basically helps your entry and exit. You don't have to be worried much of other indicators. I have not used RSI. I have not volumes. I'm not bothered about anything else. I just see who's in control. Where is my 20 SMA? Where is my 200 SMA? And what is the slope? That's it. Okay. So I'm not saying the other indicators are not useful. You can add it if you want, but you don't really need to have it. Okay. So Nifty option chain. So what is the Nifty option chain? For those who are getting started off, it's basically a matrix representation of what is happening in the market. So NSE provides you this data live. It's a delayed data. It's about 15 minutes delay. So basically, when a new series starts, what happens is basically they're going to keep it range bound between a specific set of values. This range is typically calculated by seeing the max the strike price where the maximum puts are, and the strike price where the maximum calls are. Okay, so that's going to be the range for your series. So for December and January, the range has been more or less the same. It's been about 10,700 to 11,000. Okay, and if you see Nifty above or below any of this range values, then you need to see whether the market is going to be further down or not. This typically can be gauged by looking at the unwinding data, and then you can figure out going from there. If everything remains same and if Nifty is below the max put area, that means it's a solid buy case. And if Nifty is above the max call area, it means it's a solid short case. Assuming there's no changes in the original range bound unwinding data, right? So typically you can trade even using option chain data purely. Money control gives you a place where you can see what's happened with the option chain. So for example, typically increase in price and increase in OI is basically a positive sign for the stock. It means it's a longer building up. You can go positional long for 1 to 2 days for the target. Okay. And then if you see, and the reverse is true for the short case. If you see the price decrease and OI increase, it means the shorts have got built up. The intermediate case for beginners, I would advise not to go into that because it's basically a no trade zone if you're trying to learn trading. Just stick with these two cases where you can optimize your investment strategies. Okay, so let's say the index is trading at 10,720. You need to look at the nearest strike prices. What's happening at the strike prices between 10,750, 10,700, 10,650, and 10,800? They usually command higher prices. Don't go for too far OTMs because the reason is your value is going to decrease with time. So don't hold those far away OTM calls at the beginning of the month at least, because you're going to have a severe premium erosion and you're going to lose money, even though your trade could be right. So stick with the nearest strike prices, typically within 100 or 200 or 100 to 150 points of the Nifty present value. Okay. Okay. So what you need to see in the option chain is basically, one is the call premiums. The call premiums typically increase when index and stock moves up away from the strike price, and the put premiums increase when the index and stock moves away from the down away from the strike price. Okay, what is call writing? So everything that you see in the option chain is basically writing data. So if you see the call data, you're going to see call writing data basically. These are basically traders who have sold calls, implying that there's a further rise in index or stock is not possible. And put writing is basically a position where traders have basically sold a put, implying that the further fall in the index or stock is not possible. So typically what happens is if your put writing is more than call writing, it acts as a support for the index, and if your call writing is more than your put writing for the same strike price, it's acting as a resistance. So you typically have to monitor this data on a day-to-day basis or even an hourly basis to figure out what could be the potential support and resistance for the index or the stock, right? So like I said, your max calls is going to be resistance for the index or stock. Your max puts is going to be your support. This is for the entire series. So you'll have a range of values intermediate, and you can apply the same concept again. The next is the PCR. So every strike price is going to have a PCR or a put call ratio. So PCR between 1 and 4 is typically bullish. I treat this as a contraindicator, even though the puts would be more than the the call, and the PCI between 0.65 and 0.99 is bearish. Okay, above these two values is basically you're going to get into an oversold and overbought zone. You've got to be a little careful in those areas. Okay, so let's say I've taken this snapshot of the option chain. Let's say index is at 10,700. The extreme left column is about 17 lakh calls, and the extreme right column is about 25 lakh calls, right? So this basically tells, when I look at this data, it basically tells me that the index has a reasonably good support at 10,700. Okay, don't apply this for February because the data has changed. This is, I think, December or January auction chain data. So please ignore this for the February series. Okay, so when I look at this strike price 10,700, it basically says that it's a reasonably good support for me. But what is happening is a big 3 lakhs of calls have unwinded here. This is minus 306,825. This basically means that calls are unwinding, or basically traders are quitting the position. And over here it tells me that 52,000 puts have quit the position. So during the intraday basis, what it tells me that the call unwinding is more than the put riding or the put unwinding. So you have a possibility of the index going below 10,700 towards 10,650. Which is going to be your entry point. Because at 10,650 you have another good support here at 102, 825 and 65,925. So this is one good place to enter, and then you should see an immediate bounce back towards 10,700. Okay. So a thing with an option chain is you won't get the exact precise value of 10,650 on your screen. You should have a ballpark about 10 to 15 points in your trade setup. So typically, if 10,650 is support, it may come to 10,655 and just bounce out from there. Okay. So let me talk about some indicator-based strategies. Basically, it's about I'll talk about pivot points. Pivot point is something that you could use along with moving averages and RSI and volume chart. Let me just open up the screen here. Okay. So whenever you use the pivot points, make sure that your chart candlestick is always going to be 10 minutes. Always going to be 10 minutes. Okay, so let me take Indigo here. Okay, so with the pivot point strategy, you don't wait for 1 hour, you wait for 20 minutes. That is until 9:35. So you get 2 candlesticks by then. Okay. As soon as the market opens, you wait. So let's take the case of this here. Okay, as soon as the market opens, you wait for till 9:35. Okay, and what you need to observe is what are the first 2 candlesticks done. You need the high and low of the first 2 candlesticks, or the first candlestick. Sorry. Okay, so in case of Indigo, the markets open, Indigo went in red. It opened, the high was 1193 and the low was 1180, okay, in the first 10 minutes. Okay, so you need these low points. I will add in the RSI indicator here. And I will add in the volumes. The volume is already there, okay. RSI, you have the values of 60 and 40 for overbought and oversold conditions. Okay. Okay. Now this is your candlestick which is formed for Indigo with the big red, and your next green candle is on the next 10 minutes. Okay. So whenever the second candlestick breaks the high of the first candlestick, it pretty much means the high for the day is done. Always. This is just my experience telling. It usually works on a lot of stocks. Whenever the second candlestick breaks the high of the first candlestick on the 10-minute time frame, your high for the day is done. That doesn't mean that you have to short the stock. You wait for the opportunity to short the stock. Okay? So where exactly do you short the stock here? When you break the low of the first candlestick. Okay, I repeat again, this is purely an intraday trading strategy. Please do not use this for positional. I repeat the strategy again. Whenever you see the first 10 minutes window, you take the first candlestick high and low. If the first candlestick high is broken, it means the high for the day is done. Do not short the high of the... Is
there any logic behind it?
There is no logic behind it. It's just an empirical observation I've seen with time. It's about 7 years data that I've used and I've come up with this. Okay? So you wait for the short signal, and when you short the stock, when the low of the first candle is broken. Okay? So in this case, in case of Indigo, the low broke over here somewhere in the afternoon on Friday. So as soon as 1180 was broken, you saw about 1172. Right? You book your profits and you go on. And notice the high for the day is not broken at all here. Right? And broken again. So if you want, you could hold it for the end of the day as well. It doesn't really matter. But eventually, the point is, you're going to see a value which is going to be the low of the first candlestick, which is broken. So $8 in about 10 minutes on a lot size of 600 is about $5,000 in 10 minutes. So, and your stop loss is always going to be the top of the first candlestick if you short. So that's about 1193. Okay, but usually my observation has been the stop loss usually never gets hit. You tend to walk away with profit at least between $3,000 to $5,000 within 5 to 10 minutes. Okay, and where does the RSI play a role here? I'll tell you the RSI here. Typically for sell side, your RSI should be around 40. And on the buy side, your RSI should be around 60. Okay, so over here, if you see the RSI, it's been about 49 roughly around here. Yeah, about 47, 48. So typically you would take the position around 40. 47 is slightly on the higher side, but it's fine. But typically you would take it around 40, and on the buy side you would take it around 60. So now let us look at the same thing on Reliance. You'll get a clear idea of what is happening. Okay. Oh. So this is the Reliance Marbuzu thing. The SMA has been rising. So notice that this is on the 10 minutes. So you have the big Marbuzu on the land, and the base is never taken, and you've gone all the way till about 1250. So you entered in at the high of the Marbuzu, which is 1232, and it goes all the way to 1250. So whichever strategy you use, you just stick to some basic discipline, and you should still get results. So let me look at the Reliance intraday it started over here, 9:15, right? So okay, so this is Reliance intraday. here is the first 10-minute candle with between 1237 and 1242. The second breaks the high with 1244 and this goes on to make new highs. But typically what happens is you enter the buy position once your high of the first 10-minute candle is broken. If the second candlestick is breaking the first high, my suggestion is do not take the buy position. So even though here Reliance has moved, I wouldn't have gone long, because if you had gone long here at some point, you would have been facing losses at some point here, and maybe your stop loss would have got hit. But typically my suggestion is whenever the second candle breaks the high of the first candle, don't go long. Okay? So this is the thing I was trying to come up with Reliance for on the 10 minutes. Now let us take Lupin. Right. So the Lupin SMA has been flat, basically. Right. So yeah, Lupin has started here roughly around, right? Okay. So the reverse case applies for the second candle as well. So you have the Lupin 882 as your high on the first candle, 877 as your low on the first candle. Second candle breaks low. Okay, so it basically means that you should not be in the short zone for the stock. You wait to be in the buy zone, and you buy above 882. And moment it has broken 882 here, right? And your stop loss is going to be about 876 roughly. Okay, the moment it has broken this 882, you've noticed big candles here all the way. It's gone all the way up to 890, right? So this is the key idea. Your stop loss is still safe here, even though a dip has come. Your stop loss is still safe here. It tried to hit the stop loss, but it's moved all the way to 890. So this for the buy side, and your RSI should be about 60. So as soon as hello. Right? Okay. So let me reiterate the strategy here again, if you have not understood. So I'll come to pivot point slightly a bit later. So the first strategy is basically when the price of any particular stock has crossed the resistance of hold on. Okay. When the price of any particular stock hold on. Hold on. Let me just get in the pivot points as well. Okay, I'll just add in the pivot point. I'll just remove the SMA. Okay. Okay. So this is basically the pivot point. So for pivot points basically tell you the resistance and support for intraday. This is not, again I'm reiterating, it's purely an intraday trading strategy. You should not be carrying positions overnight. Okay. So whenever the price of the stock crosses the support with volumes, it is a buy. Okay? Whenever the price of the stock crosses the volume, it is a buy. Okay? So you notice here, and if it crosses the first 10 minutes of the candle, it is a sure shot buy. Okay, in this case, in Lupin's case, you can see that the first candle high is broken with volumes. Okay, and it got settled the base got settled around 880, around 884. So you would enter the stock here with the stop loss as 877 roughly around, and then you would exit at around about near 90, and it came up to the resistance, which is about 889.86. So, which is a fairly reasonable indicator to where your exit and entry has to come in. Okay. So what I'm trying to tell you is, whenever your stock crosses the resistance of your last candle with volume, or your first candlestick with volume, okay, you go ahead and take the buy position. Your basic target for intraday trading is about 5 to 6 points from your entry point. Okay, and it usually comes within 10 to 15 minutes. So I wouldn't be in the stock for more than that. Okay, and the reverse is true for the sell side. So whenever your support is broken with volumes, you have to take the sell position, and if your basically your RSI should be around 40, you take the sell position at that point. Okay. So there's one thing which I noticed here is the breakout strategy. So this is what I was trying to tell you. You first see the first two candlesticks, which is at about 9:35 in the morning. Okay. Stocks, and the breakout is going to happen when the high or the low gets broken of the first candlestick. Okay. So let's see chart patterns. Chart patterns are basically extremely good, reliable indicators. It rarely ever fails. You don't really need confirmation from other things. Basically, because every trader looks for these patterns, and as they say, market is driven by sentiment. Every other trader, when they figure that the pattern is visible, they're going to take the position accordingly, because they've figured the same type of theory back in the mind. Okay, so let us look at. Let me open up investing here. Slightly easier on chart pattern. So if you look at Nifty, right, so chart patterns basically work on longer time frames, that is the weekly and the daily and the monthly. They're extremely reliable. I don't use it for intraday because I find it less reliable on intraday. But for positional, if you want to take a positional trade, then you're better off using just chart patterns on the weekly and the monthly. So if you take the Nifty, I've taken the Nifty here, and let me take the weekly charts for Nifty. I use candlestick typically, so okay. So this is the typical Nifty weekly chart here. It has formed the top here. It basically formed a head and shoulders pattern here. This is the left shoulder which is formed. You've got the head here, and it's trying to form the right shoulder, but it's not formed yet. So it's not really the right shoulder is not developed yet, and it's not clean as well. Okay, so ideally what happens is you wait for the shoulder to form, and you wait for the shoulder to break as well to take the short positions. Okay, one of the patterns which I fairly use is a 2B pattern, is basically the sell side and the buy side. So what happens is, let's say if you have missed a big bull run, like in the case of Reliance, which ran from 1094 to 1250, right? So you may, or even in the case of Havells, which ran from 650 to 740. So let's say you missed that bull run. So now you, as a trader, you accept that you missed that position, and but you'll always be looking out for new opportunities that the same stock is coming to give. So in case if you miss the bull run, you'll always get the sell side, which is basically the short position, and if you miss the short side, you'll basically get the bull side, which you have to look into. Okay, so typically what happens on the bull side is a high is made. Okay, once the high is made, traders start profit booking or whatever. Low gets done, a dip comes, and then a fresh high is made, which is basically a breakout. Okay, and once the breakout is done, the moment you close below the breakout, you go for a short. That is for the sell side, and the amount where you're going to book is basically the entire retracement of the bull run. Okay. So let us look at Ashok Leyland. Okay. Leyland is basically, this is a weekly chart of Ashok Leyland. Okay. So a high got made here around 150, or for that matter, even here around 133, and then you had a nice little dip come down to about 107, and then your fresh high got made all the way up till 166, right? And notice that in each fresh high, none of the dips closed below the breakout candle. So it was not really short until then, okay? So the moment we close below the breakout candle, which is over here, 148, we close below 148 here, you have to retrace back all the way till 81, and that's what has happened here. Because 81 is where the bull run has started, and that's what has happened here. Right? So the moment we close below this breakout candle, which is around 167 on the weekly, we closed at 148 on that week, we retrace all the way back to 81. So this is your 2B sell pattern. You don't need other indicators. You don't need volumes. You don't need RSI. You just look at this chart pattern. You say, hey, this is a sell. I'm just going to keep charting this till 81 comes. Right? Okay. Now let's take a look at Reliance. Reliance is, okay. So Reliance Industries, okay, is basically on the 2B buy side. You've missed the bull run here. Keep a watch for this on the sell side, because this is a breakout. Okay, it's heading towards a double top formation. Could be a double top. Okay, this is on the weekly, and the moment we close here below 1240. We have retraced only to 1020, but actually we need to retrace all the way back to 870. Okay? So keep a watch on Reliance, and still we have not broken the high of the breakout candle, which is 1323. So per my chart, Reliance is still a sell for a target of 870. Okay? Now, how soon it's going to take, I don't know. How fast it's going to take, I don't know. As a trader, I'm only going to see my stop loss and my target. Okay, if I've taken a short position at say 1238, you've got the small traders can book the profits around 1020, right? So you've still got $200 on your short. So technically, still Reliance still remains a short until 1390 is taken out, 1325 is taken out. Okay, for a target of about 870. Now, let's look at Havells. Okay. Havells over here, Okay, it's basically broken out. It's similar to Axis. It's broken out on the double top as well. Okay, so this is a weekly chart. The moment we are going to close below 710 or 712 on Havens, on the weekly we are heading down all the way. This is from here where the bull run has started, till about 550. Okay, so Havens is still looking like a short, but I wouldn't short it at this point here just yet. For safe traders, it's better to wait for confirmation. You're better off shorting it only when the weekly closes below 710. Okay. Okay, and now on the 2B buy side, right? So if you look at the Havens chart here, it's broken down. You've got a dip. You've got a dip here. It comes up here and here, right here. It's closed right above the breakdown bar, which is this one, which is the big red candle here. Okay, it's closed right above 347. You go long here at this point for the entire retracement all the way up to 456. You've got a lot more than that, but eventually your retracement is going to come. Okay, so this is for the 2B sell and the 2B buy. I would actually recommend you to spend some time reading this, understanding the strategy, because it's an extremely powerful pattern on all time frames. It's going to be extremely powerful on the weekly as well as on the monthly. Even if you want to use it for intraday, you can use it. Use it on the 15-minute window. It should still be fine. Okay. So. Okay, so the dragon pattern. So the dragon pattern is somewhat an unusual pattern. It's not really like a common pattern which people bother to or look to investigate. It's a pattern which is not easy to find on the chart because it needs some calculations and stuff. My suggestion on the dragon pattern is basically I would actually like to cover this in some other session because it needs a little more understanding of chart patterns and familiarity with chart patterns and things like that. Okay, I would want to go back to the concept of investing and how people have to invest if you want to be in the investing market. Okay. So for investment, like I said, you always use the monthly charts. You don't use any other chart if you're looking to invest in the Indian market. Okay, the reason is multiple fold. I mean, I don't trust the financial media in India. People don't give honest reports of what is happening within the company, and one fine day scan erupts and the whole thing just blows out of proportion. So always look at the monthly chart. Always have your 20 SMA on the monthly with you. Okay, and you use the Marbuzu technique. Okay, moment you have a bullish Marbuzu on your monthly time frame, go long. And if your Marbuzu is close to your 20 SMA, go long. Okay, as usual, it has to be about 200 SMA as well. So you need two SMAs, the 200 and the 20 on the monthly. Okay. Do not use any other time frame for investing. The reason I'm saying this is because you're more the odds of you getting 100% plus on your investments is pretty high. It's almost close to 95 to 100%. So the moment you get your bullish Marbuzu on your monthly, you're above your 200 SMA, go long. If you look at the Havel's chart, it gave the first bullish Marbuzu at 50 rupees. Right? If I zoom it here, if I zoom the chart here, this is your 20 SMA. It gave the first bullish Marbuzu at about 50 rupees. And today it's about 700. And notice how the chart has never, you've never got a bearish Marbuzu on Havel's at all. It's never closed down below the, it's never closed below the 20 SMA on the monthly. So from 50 rupees, you've basically ridden till 750. And when you exit your position, the moment you get a bearish Marbuzu below the 20 SMA. Okay? So iSure is the other example. Right? So you enter iSure at around 2,500 rupees because you've got a nice bullish Marbuzu there. Okay? And you exit. Hello? Yes? Okay, yeah. Okay, yeah. Okay, so coming back to iShares investment, so you have entered in at around about 2,000 rupees, roughly about on your first bullish Marbuzu here. You don't close until you see a bearish Marbuzu below the 20 SMA, and it closed below at 24,000 rupees. Okay, so always use only the monthly chart if you're looking at investment. Okay, and even though stocks are falling now, a lot of them look attractive. None of them are in a position to be, particularly in the mid cap, they're not in a position to be invested. One other example is Lean. You notice this is a Lean monthly chart. You notice all the bearish Marbuzu here, huge ones. I mean, it's gone from 41 rupees to 350, and then it's come back all the way back to 40 rupees again. Right? So, but keep a track of all these beaten up stocks, because moment you have your 20 SMA and your green Marbuzu forming up like this, it's right for investment, right? This is on the monthly chart. So no blah blah of what is that? Balance sheet. Don't bother what the financial media says. Don't bother about profit revenues. Okay, and all those things. It matters to some extent, yes, but then if you stick to your chart, you'd have exited with a good amount of profit by then. Okay. Remember, a bearish Marbuzu below your 20 SMA is the place to exit for your investment. Any stock, doesn't matter which one it is. Always use the 20-month the monthly time frame for your investment. So keep a look at. Hello.
Amit?
Yeah.
Can you explain about Marbuzu candle just for one? You know, people are not used to the terminology, so just explain about that candle just quickly.
Yes. I will tell you about the Marbuzu candle here. I've given a picture here. Okay. So this is your Marbuzu. Marbuzu typically looks like this. It's basically a Japanese term. But from the trading perspective, what it means is the bulls. If you see a green, it means the bulls are in command, and if you see a red, it means the bears are in command. Okay. So you don't see a low wick in the Marbuzu, nor do you see a big high wick in the Marbuzu. Typically, I take a variation of it, but you don't get exact patterns on charts, so you'll have to stick with slight variation. So if you look at the, I'll go back to iShares. Okay, so I'll zoom this in. Okay, so this is your beautiful Marbuzu which is formed. It is formed in 3 consecutive months, but this is where the bulls are coming into command here. You see this nice green blocks that have come here? Okay, it basically tells to me that the bears are getting out of control here because the lows are not being formed. The lows are not being formed. It's always a new high, new high, new high, and bulls are taking it further and further and further. Okay? So you keep your stop loss at the base of your Marbuzu and you invest. Okay? This is on a monthly chart. So I'm talking from the perspective of investing here. Okay? So the Marbuzu base in case of iShares is 3939 and your entry point would be about 4603. Okay? So it sounds high at this point, but technically speaking, it's from the investment perspective, you have to invest. You don't see the price. When you see who's in command and you just get ahead with it. Okay, so you buy the stocks here, you wait for, typically on a monthly time frame, you have to wait for about 6 months to 1 year to get your wonderful returns that you have. So let's say you wait 6 months, you exit at about, say, 3, 4, 5, 6. Okay, you exit at about 6,774. So it's about 20% returns in 6 months on the virtue of 6 candles from where you've gone in. So these are your Marbuzu candlesticks. You notice that over here, again, one more Marbuzu is formed. Bulls come back in command. There's no downwick here, unlike these candlesticks. Okay. So once you have this type of formation on near your 20 SMA, that's the time to go and invest and put your money in. Okay, and the reverse is true for exiting your portfolio. Okay, the moment you have a Marbuzu which is formed below your 20 SMA, like this over here, okay, you have to exit your portfolio. Okay, until then you can hold it. So your strategy is basically going to be, I'm going to invest at the base near the 20 SMA on the monthly on the bullish Marbuzu, and I'm going to exit at the monthly SMA bearish Marbuzu closing below the 20 SMA. So in iShares case, you've gone in from 4,600 to about 20,000. Roughly about. So you exited somewhere here, roughly about 20 to 24,000. So this is your simple investment trick if you don't want to be bothered about all kinds of nonsense that goes on in various companies. And even in case of DHFL, which is scam ridden, right? This technique should work. Okay, let's look at that DHFL. Okay, so here's your first Marbuzu which came at about 100. Okay, and this is your first exit point, which is at 186. So you have ridden from 100 to 186, which is a phenomenal returns of about 186%, right? Now, you don't know what to do here at this point because you've closed below the 20 SMA, it's bearish Marbuzu, you exit your portfolio, and you wait again patiently if a bullish Marbuzu is formed. So you form it again here at 288. You enter in at 288, you've now closed below, okay, and all of a sudden you've got one here. You've ridden the wave all the way till about 680, and then you've got one crash down till about 276. So let's say if you've not exited at 680, okay, your investment is at 288, is at 274. So even though DHFL has lost 50% from its highs, you have lost only about 12%. Okay, so you're stuck to this basic principle. I'm going in long at the bullish Marbuzu, which is at about 288, and you have exited at about 274. And this is from the backdrop of an 86% return. So if you've done the whole thing fully, you'll still be in net profit, right? So that, I mean, you hear stories of people losing 50% and stuff because most of them would have gone long here somewhere over here around 550, 560, and then you had one fine big crash and everything just goes off. But if you've entered in at the right time, which is what the monthly is saying you'd enter, which is around 288, you wouldn't have lost much. You would have exited right here at 276, right? So this is how you can protect your investments and portfolios. I mean, you don't have to worry about scams and other things. I mean, of course, a lot of firms are there, but yes, as a retail investor, this is the best you can do. And this is going to safeguard you 9 out of 10 times. It doesn't matter which market it is. Okay? So I think I'll wind up the session for the day. If anybody has any questions, can it be opened up? Hello? Yes?
Excellent session, Samir. Lot of good information. And
yeah.
Very nice to
Sudarshan is asking about RCOM. So let's look at RCOM. So I am touching a few stocks which have got beaten up and hit investors, right? Okay. So I don't have the RCOM data here for a long time. Okay. But anyway, looking at RCOM, right? You exit at about 448.